It's the midpoint of 2025, and we are at a moment of sharp inflection in the global economy, an uneasy détente between disinflation and geopolitical risk, and between policy patience and structural fragility. Hello, I'm Jeremy Maggs, and a warm welcome to No Ordinary Wednesday, where we explore insights and perspectives on issues that shape economies and global markets. Now, after nearly 2 years of aggressive tightening, major central banks in the US, UK and Europe have opted to pause, caught between cooling inflation and the risk of doing too much, too fast. But the world remains on edge. Markets are jittery, consumer sentiment is brittle, and supply chains remain exposed to one of the globe's most strategically vital choke points, the Strait of Hormuz. That is in the eye of the storm as tensions escalate in the Middle East. Here at home, the South African economy growing by a modest 0.1% in Q1. Better than expected, but hardly enough to offset years of stagnation. There is much to discuss, and I'm going to leave that to Investec chief economists Annabel Bishop in South Africa and Philip Shaw in the United Kingdom. Phil, Annabel, a warm welcome back to both of you to No Ordinary Wednesday. Phil, let's begin with a global picture. How are markets reacting to Middle East risk premium, particularly with recent threats to close the Strait of Hormuz, through which 20% of global oil currently flows?
Sure. Yeah, it's a very good question. Bear in mind that the US has launched attacks on 3 nuclear enrichment facilities deep in the heart of Iran. The market response has been pretty subdued given what's happened. If we look at individual reactions, if you look at currencies, the dollar's gained around a cent against the euro, less than that against sterling. Looking at sovereign debt markets, 10-year Treasury yields are about 5 basis points or so lower than close on Friday. Right now, US stocks, the S&P 500's opened more or less flat. And yes, we did see a spike in oil prices by about $4 a barrel, but they've actually now fallen a touch below levels they were on late on Friday. So we've certainly seen no panic. And I think the justification here is that the Iranians seem less likely to plan a major retaliation, probably something that's a bit more token. And with several senior military Iranian leaders killed last week, it sees to why markets are not taking any threats of severe Iranian retaliation too seriously. And really what they're doing is waiting for the next steps.
All right, just a note for our listeners to No Ordinary Wednesday. We are recording this conversation on the afternoon of Monday, the 23rd of June. So, Phil, let me stay with you. And how significant then is the risk that supply disruptions there could derail the fragile global recovery? And what knock-on effects might this have on inflation and, I guess, broadly financial markets?
Yeah, if we're talking specifically about energy, we're pretty confident that the world economy can survive oil prices at current levels or even somewhat higher. I think if we cast our minds back to the beginning of this year, 2025, then Brent crude reached $83 a barrel, and that was with the US dollar stronger than it is right now, so firmer oil prices in local currency terms. In the UK, we're actually more sensitive to gas prices, as anyone who remembers late 2022 can testify. And on the back of what's been happening in the Middle East, gas prices are up. And if that's sustained, then it's something we're going to have to factor into our inflation forecast, our CPI forecast. But just for perspective now, some of the near-term gas contracts in the UK are at around 110p per therm from below 100p. But back in 2022, 2023, they were up at 800p a therm. So the forecast changes we make, if we do make them, would be relatively modest.
All right, Annabel, let me throw it to you now. South Africa, as we know, is deeply exposed to commodity cycles, with geopolitical shocks pushing up oil and obviously a volatile rand. What's your inflationary forecast, and will prices rise at the pump? It's an important question.
Yes, hi, Jeremy. Look, I think, what's absolutely key for South Africa is that oil and indeed petroleum products overall is our biggest import. So what happens globally in these markets is very important to us. Interestingly, our largest export is metals and minerals. So again, the fact that we're exposed to global commodity cycles also has an impact on our currency. We're both an emerging market currency and a commodity currency. Now you combine that, and of course we've had some recent rand weakness, with the fact that we've obviously seen higher oil prices, and at the moment there's a petrol price increase incoming for the month of July. The current estimations around 50 cents a litre, but that's likely to rise over the course of this month. Of course, we do expect to see a further climb in oil prices to potentially just over $80 a barrel. It does appear from many different sources that the war in the Middle East is not going to be something that's overcome rapidly. In fact, we saw obviously the escalation this weekend with the US becoming involved, obviously having a key impact as well. So South Africa, unfortunately, is beholden to the global environment, and this has a particular effect on inflation figures. A 50 cents per litre increase in the fuel price is not on its own going to cause any derailing in our inflation numbers. But in any case, as we move towards the end of this year, South Africa's CPI inflation was expected to rise towards 4 to 4.5%. That comes off the back of base effects from inflation falling last year. And of course, these modest fuel price increases currently being signalled will add to that. Although it's important to bear in mind the risks to the upside, and we could see significantly more on the fuel price increase front.
So, Annabel, based on that then, can the South African Reserve Bank afford to be hawkish? How constrained is the SARB in balancing domestic weakness with global monetary caution?
So I think, we wouldn't characterize South Africa's Reserve Bank as being hawkish. We've actually seen a cut in South Africa's interest rate at every single meeting since September last year. We, of course, did see a pause in March, and that was ahead of the US Liberation Day and concerns over the very substantial nature of tariff increases which transpired. We know now there's been a 90-day pause, and this obviously will be helpful for the second quarter's trade outcome and particularly for global growth. But as we move into the interest rate cut meeting, which will obviously occur now in the next one in July, the risk is certainly that the Reserve Bank may decide to pause again until we see how those outcomes come through from the widespread negotiations we've seen around the world, with many countries meeting with the US to obviously discuss trade and, of course, investment as well. So the South African Reserve Bank is keeping a very close eye on South Africa's GDP outcome, closer to 2% over the last decade. It's really dropped to 0.5% on average GDP growth for the decade to date, the first half of the current decade. So really, we do find ourselves in a constrained position. And of course, more interest rate cuts do help. But really, the ultimate nature of our malaise comes back to structural issues. We find ourselves beholden by the ongoing freight crisis at Transnet in particular, without which the presidency says economic growth would be 3% higher. So instead of 0.6% last year, we could have had 3.6%. All of these factors really talk to the need for more supportive economic growth initiatives and improvement in the business environment. And of course, the Reserve Bank can do little in the face of that. Really, these 25 basis point cuts do help a bit for the consumer, but it's not going to return us to economic growth rates of 3% plus on their own.
Phil, on the point of central banks, the Fed, European central banks, and also the Bank of England have been cutting interest rates, although the Fed hasn't eased since December last year. Is there any room for further rate reductions this year, do you think?
The ECB cut its deposit rate, its main policy rate, to 2% earlier this month, and we feel that we are probably at or very close to the bottom of the interest rate cycle there. And what we've got throughout the wider EU generally, but also specifically in Germany, is a huge amount of prospective fiscal expansion. And we judge that that's going to make a material difference to medium-term economic momentum. So the ECB is really in wait-and-see mode at the moment. We might get another cut again next month if we see a gloomy picture surrounding tariffs being reinforced. In terms of the Bank of England, the strategy is still likely to be gradual and careful rate reductions. Certainly in our view, the medium-term inflation picture still looks okay, and it looks likely that we're going to get another reduction in interest rates in August. It's really in the US where we have got a different picture, and of course that's because the FOMC is fearing an inflationary impact from tariffs, and importantly one that not just raises the price level but one that feeds into higher wages as well, so that entrenches inflation into the medium term. Our base case is that by the end of the year, the FOMC concludes that any increase in inflation is likely to be temporary and it begins to loosen policy again. Now, of course, that's going to depend on many factors, including where the tariffs go, but also avoiding a very sharp slowdown in the economy where you actually see the opposite picture, and that could encourage the FOMC to ease earlier. But our central view is that the Fed cuts rates at the end of the year when it's reasonably satisfied that the medium-term inflation picture isn't dangerous.
Annabel, if global rates remain elevated for longer, how exposed then is South Africa's sovereign risk profile to another bout of foreign investor retreat?
So I think the global interest rate cycle is showing some concern around inflation outlooks. We've seen the latest forecasts for the key PCE deflator, the core price index that the Federal Reserve Bank looks at in targeting its inflation at around 2.6, 2.7%. So what that really means is that forecasts are rising for US inflation, and that, of course, does provide some risk for South Africa in terms of the interest rate cut front. Now, your question on the fiscal position, of course, talks to the fact that South Africa has very high debt levels, and those obviously nearing 80% of GDP. The norm for emerging market countries is seen closer to 60% of GDP or less for a sustainable fiscal position. The situation in South Africa has deteriorated quite rapidly since the COVID lockdowns. If we see interest rates remain elevated for longer, I think you'd also need to look at the global fiscal position as well. And in fact, around the world, there has really been a deterioration in government finances, both because of the lockdown, also because of sub-trend economic growth. So the bond market in South Africa, the issuance of government bonds, and of course, those are readily taken up, that really has been more orientated towards domestic buying as opposed to foreign investor buying. The majority of South African government bonds being held by actually South African domestic banks. And if we do go through another round of foreign investor retreat or, particularly global financial market risk off, we're already seeing quite a bit of that. South Africa's bond market will be supported, but obviously it will continue to tick weaker. The overall point really for South Africa's government bond market is that we do tend to see much stronger bonds. We tend to see lower yields when we're in a strong economic growth environment. And of course, in the 2000s, we saw the benchmark 10-year government bond yield close to 6%. And now, of course, above 10%. And that's really because the supply has blown out. And of course, along with that, then that caused credit rating downgrades and has also been negative from an investment perspective. So, many factors do go into it. And the recent budget did see the cutting back of planned expenditure and improved revenue. But South Africa, in order to make substantial strides in its fiscal position, really needs to see economic growth running between 3 to 5%, organically growing government revenues, and obviously supportive then of funding South Africa's expenditure needs.
We're going to continue this conversation in just a moment with a global economic outlook from our chief economists in London and Johannesburg. But first,
in a world of information overload, it's easy enough to know what's going on, but it's more important to know why and what it all means for you and your money. Get the analysis behind the headlines. Follow Investec Focus Radio SA for economic and investment insights from the experts. Subscribe wherever you get your podcasts. Investec Bank Limited is a licensed FSP. T's and C's apply.
So, Phil, we're fast approaching the 9th of July, the end of the 90-day pause on the so-called Trump tariffs. So my question then is, how has the global economy reacted to the tariff threat so far, and what are you envisaging post the 9th of July, particularly when it comes to the important reaction of China?
Yes, difficult question. I think in terms of the way that the global economy's dealt with the tariff picture so far, it's one of uncertainty and halting spending because the economic outlook really isn't very clear. In terms of the picture looking forward, our baseline forecast has most tariffs remaining at 10%. And I have to add, that's not because we're confident that we will not see a return to reciprocal tariffs, because I think at this juncture, it's impossible to be confident about anything. But we do judge that it's a reasonable set of assumptions to base our forecasts on. There is a fair chance that President Trump doesn't move tariffs up on the 9th of July back to the reciprocal tariff structure he outlined back in April, and he extends the deadline for 3 months. Now, if we see another increase in US tariffs, In terms of the domestic US economy, that pushes inflation up, slows the economy down. That's something that President Trump really would not want to see. And that's where you get the so-called taco trade from, which stands for, of course, Trump always chickens out. But on a purely practical sense, if the US is negotiating with a couple of dozen countries on tariff structures and other trade practices more widely, it's difficult to see how those trade negotiators have the bandwidth to conclude everything by the 9th of July. And so I think it's a fairly reasonable assumption to say, look, that can is going to get kicked down the road, at least for most of those countries.
Annabel, South Africa, of course, also bracing itself for what's next on the tariff front. What's your thinking? What's your assessment?
Yes, Jeremy, quite interestingly, South Africa's trade account with the rest of the world to date, globally continues to run above that of last year. And of course, that has been both due to the moderation in oil prices and, of course, rand strength, which helps us on our imports, as well as some improvement in exports. Now, with the pause on implementing the tariffs of Liberation Day in the second quarter, that could be expected to continue. But as we move into third quarter now, there's obviously key worries around the fact that South Africa could see impacts of higher tariffs, remembering that we are obviously benefiting from no tariffs on many metals and minerals, our key export, but it is still expected to impact our automobile and, of course, as well, agricultural trade sectors. So all of these factors are quite key in the economic outlook. We are obviously waiting to see what exactly is going to happen. President Trump himself has said many times that he's open to negotiations and that, in fact, during this period, countries around the world will be negotiating with the US. And if they continue to do so in good faith, they might even see an extension of this tariff pause. So, overall, I would say there's still a high degree of uncertainty. Some countries have reached deals. For South Africa, I think it's going to have to be give and take. The US may well want us to import more, which it has signaled, oil and gas. And of course, given the tensions that we're seeing in the Middle East, South Africa already importing some oil and petroleum products from the US. The expectation is that South Africa may well, do more of that. But the bottom line, of course, is that it's one of the factors why there's been a downward GDP growth revision for South Africa this year. We're looking at 0.9%. Consensus forecasts are around 1% for South Africa. Key to note, these have been revised down from this Bloomberg consensus forecast to the currently 1.1% from 1.7% at the start of this year. So these really are seen to be quite significant factors. And of course, there's also been a negative impact on global growth and global sentiment.
Phil, let's pivot now from tariffs to the currencies. And what's your currency outlook as far as the dollar is concerned?
Yes, we're currently in our monthly forecast round and we're looking pretty hard at this issue. But what we've concluded so far that we don't really see a major reason to change our view that the greenback is going to weaken moderately this year and next as, for one reason, the US economy proves less resilient. And also, investors are just more wary about the economic credibility of the US administration as well. We've spoken about tariffs. I mean, that's certainly one factor. Another important issue is fiscal policy and the debt trajectory that is implied by the fiscal bill, which Trump is trying to get through Congress at the moment and which has effectively led to the recent Moody's downgrade. I think the other factor to remember is that the greenback has been exceptionally strong for a number of years. And under these circumstances, again, it's not unreasonable to expect some pullback. So, yeah, we're currently looking at the precise numbers, but really we are looking towards a further, probably moderate weakening in the US dollar against most major currencies this year and next.
So, Annabel, what impact would this dollar weakness have on emerging markets and in particular our economy?
So the US dollar weakness has actually been very beneficial for South Africa's rand against the US dollar for the cross rate. And that really comes to bear on the fact that when we import our oil and petroleum products, they're obviously priced in US dollars. So strength for the rand against the US dollar then has a disinflationary effect. It tends to mean that inflation pressures moderate. It's been a key reason why we've actually seen low inflation this year. If you look at our second quarters and indeed the first quarter's inflation figures, the second quarter is now showing CPI inflation below 3%, the first quarter very moderate as well. This, of course, also comes to bear on agricultural prices, and that's the largest food prices, the largest component of South Africa's CPI inflation basket. The country is obviously self-sufficient in terms of food production, but the prices of our agricultural products are obviously priced against international agricultural product markets, and that really means that if you do tend to see some rand strength, that also has a positive impact on inflation as well. So most recently, we've seen a little bit of weakness for the rand against the US dollar. It's been very mild, but it's partly come as the US dollar has strengthened somewhat. Again, very moderate moves, but as a consequence of the elevation in global risk aversion, there obviously has been some safe haven buying. Going forwards, we eventually do expect to see the war in the Middle East subside, and that of course would then be helpful in allowing the rand to see further strength against the dollars. And then of course that would obviously then imply that South Africa could see some more improvement in terms of the feed through into inflation. But really, Jeremy, what matters the most is how long does this war in the Middle East last? And of course that's a key concern.
Phil Shaw, let's move from currencies to growth. We're seeing moderate growth in Europe. Are you expecting this to strengthen in coming months?
I'm afraid I'd have to disappoint everybody and say no, not in the near term. And what we've seen throughout Europe, not just in the EU or the Eurozone, is that we had a boost to economic growth at the start of the year. And that's because firms and economies essentially forestalled high US tariffs ahead of the so-called Liberation Day in early April. And that had the effect of pushing up GDP figures for Q1. It made them artificially strong. So if we're looking at the Eurozone, Euro area growth was recorded at plus 0.6% quarter on quarter. And, one interesting stat, if you look at Irish growth within the Euro area, that was 10% or nearly 10% quarter on quarter in Ireland. So in no way are these figures sustainable. And actually, we wouldn't be at all surprised if GDP contracts in Q2 as, if you like, a sort of payback to a firm Q1. Longer term, it's a different issue. And as I mentioned earlier on, fiscal policy should be a major support to the Eurozone economies in general, and in particular infrastructure in Germany. And actually, in the latter case, that could actually raise productive capacity of the economy and raise medium-term growth. But that's not a short-term issue. It's something that we're looking at, perhaps kick in 2026 and beyond.
Annabel, growth in South Africa, as I mentioned in the introduction to this conversation, remains stubbornly weak at only 0.1% in Q1. Little sign of a broad-based recovery. How much of this underperformance is cyclical versus policy-driven?
Jeremy, I think it's to a large degree both. And if you actually have a look at some of the longer term trends in South Africa, those are key too. We've actually seen business confidence depressed for most of the past 15 years in South Africa. This is a poor situation to be in. It implies that the majority of businesses are dissatisfied with trading conditions, with profitability. It signals this weak economic growth environment we were talking about previously. That 0.1% GDP growth outcome for the first quarter would actually have seen a contraction were it not for the strong outperformance of the agricultural sector. Now, our agricultural sector is a very small part of the economy. It's around 3%. So such is the weakness of economic growth that a tiny sector of the economy actually has such a significant impact. So the bottom line is that we obviously need to see a vast improvement in the business environment in South Africa, the ease of doing business, the OECD notes, but also, of course, as well, we have seen quite weak foreign direct investment into South Africa. Your major foreign investment flows tend to be on the portfolio front, coming into your bonds and equities, and of course not so much on the hard fixed investment front. The broad-based recovery that people were hoping for this year, with expectations that growth could accelerate through 2025, has not been the case. Instead, we've actually seen disappointing economic growth outcomes. And really, we look at the forecasts for Bloomberg, we mentioned earlier, down from 1.7 to close to 1% now. Of course, we have seen a cessation, by and large, in the load shedding environment that we had become accustomed to in Eskom up until the end of March in 2024, while we only have a few bouts of load shedding now. And of course, the positive news that we're likely to get off the greylisting in October this year as well. Those are strong evidence of the work the business-government collaboration has done. But unfortunately, Transnet is much slower to turn around. Transnet needs a huge amount of money and investment. It retains a large amount of debt on its balance sheet, which inhibits its improvement. And of course, as well, the utility remains also, unfortunately, vulnerable to theft in terms of infrastructure, metal theft, and all of that has weakened Transnet's capacity to deliver in terms of the need. So unfortunately, the structural issues do persist.
Annabel, just a quick one on the grey list that you mentioned. October is the time that we're confident about getting off that list. Would this be looked on favourably? I imagine it would be, by the ratings agencies.
So interestingly, when we actually went onto the grey list, Jeremy, the rating agencies weren't very negative about the situation. I think they really indicated that while it was expected, they also anticipated South Africa to eventually get off the grey list. Now, of course, it's taken longer for us to do so than perhaps the Mauritius example. That Mauritius, obviously a smaller country and, easier to work together in terms of the requirements. South Africa's done quite well. It moved quite quickly through reducing its deficiencies. Obviously, only had 2 deficiencies left, and now indications are coming out that we have managed to work through what's needed to be done and could come off the grey list. I think it talks more to investor sentiment and South Africa's investor environment. Look, overall, the credit rating agencies really only do one thing, and that is look at the ability of South Africa to repay its debt. Now, of course, if you are increasing the supply of debt, as South Africa did from the mid-2000s, from close to 20% to obviously now close to 80%, you understand why we had the deterioration in our credit ratings and, of course, the increase in our bond yield so substantially. The improvement in South Africa's perception by the Financial Action Task Force and by investors in terms of, the ability to invest in the country more safely is a positive and, could provide some improvement in terms of foreign investor flows in South Africa's bonds. But ultimately, investors want to be sure that South Africa doesn't find itself in a situation where they continue to lose value. And that's, by buying Rand bonds, for example, because you continue to see Rand weakness. In fact, one of the key points of bringing in a lower inflation target, which has been discussed quite extensively in South Africa, is to reduce the substantial Rand weakness that we have been seeing, to obviously bring our inflation rate closer to those of our key trading partners, which is, seen to be targeted at 2% for the US, China, Europe, and of course the UK. And those factors, I think, will be more instrumental in improving South Africa's fiscal environment, to improve the credit ratings, as will, of course, as well, reducing the expansion of debt and actually starting to wind some of that in.
I want to bring this conversation to a close, and let me end with this. And Phil, I'll come to you first of all. Same question to both of you. 2 critical risks and maybe opportunities that you're watching in the global economy in the next 6 months. Phil?
There's quite a lot, but I think we have covered the main 2 factors really that would most affect the global economy. And I think the first is tariffs, and we'd like to see some progress made and US tariffs falling, which would give business certainty over the economic outlook. And also we'd like to avoid the world descending into a tit-for-tat trade war as well. The second issue is obviously we'd like to see a de-escalation in the Middle East conflicts in the regions where that's actually happening. That would be positive, of course, in human terms as well as in terms of economic prospects.
And Annabel, last word to you.
Yes, thank you. Look, I think the global tariff environment problems certainly can't be avoided. We obviously will be waiting with the rest of the world to see what manifests in July. It certainly does seem that the Trump administration puts out harsh or scare tactics and then winds them back in when they tend to either see value in doing so or where they see their objectives being closer to being met. But that, of course, talks also to global risk aversion in financial markets. And that's quite key as well. We saw a shoot up in the month of April and then quite a lot of reduction in global financial market risk aversion in May and early June. And that really did come through as we obviously saw the pause on the tariffs, but also the clear demonstration by the US that's willingness to work together on countries around that. So that's key for the Rand. When we do tend to see a reduction in global risk aversion, it tends to see some Rand strength. And of course, also as well, that's then helpful to our inflation environment, interest rates and GDP growth. So I think, that's something we can't really get away from for South Africa. Also, it will be key for us as well is to see what happens in terms of some of the, I'm not going to repeat what Philip said around the Middle East, because that's obviously important for us as well. But looking at South Africa's exports, with majority of our manufactured goods going to the Eurozone, we're going to continue to see, what happens in the longer term in terms of carbon border mechanism adjustments, the regulations that are going to be put on South Africa's exports to Europe, if they are mainly fossil fuel manufactured and not not obviously manufactured through green energy, that's going to form a form of tariffs or tax on our exports as well. So that's also quite important on that global trade environment. But really for South Africa, what we need rather, Jeremy, are structural reforms inside, growth-driven economic reforms. The interesting events that we've had recently have been that the ANC, our largest political party, has lost substantial votes, as you know, falling below 50% to 40% in the last election. This year, polls showing it falling closer to 30%, as it's believed that the ANC is not driving economic growth, bringing through populist economic policies instead, and that is something which has really deterred foreign investors as well. So I think, the turnaround of this, where we actually see other members of the Government of National Unity having more sway in South Africa's direction of the economy, would be very positive for foreign investors' sentiment.
And that is a bumper edition of this podcast. Annabel, Bishop, Phil Shaw, thank you both for joining me on this episode of No Ordinary Wednesday. And as always, if you enjoyed this episode, please follow Investec Focus Radio SA wherever you get your podcasts. We will be back in a fortnight with more analysis on the major economic trends shaping our markets. Until then, goodbye from me, Jeremy Maggs, and the entire Focus Radio team.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Limited and subsidiaries, authorized financial service providers, registered credit providers, and long-term insurer.